Now, as we're looking at some of the other pairs, U.S. Swiss franc, again, this is a very, very important setup that I'm going to show you. You will see this type of candle. I would primarily focus on this candle in the H4 and the D1. This is a daily chart we're looking at right now. This long wick, this body and the top of this candle has virtually no wick on the top of that candle. In this particular scenario, what we're looking for is we're looking to buy on the very next candle. Now, this is a classic case because this has identifiable support here. The wick broke through that support. Trader goes short. Within a matter of hours, he stopped out. And then, however, with myself, my clients, the people I work with, we are pre-programmed that when we see this, we immediately buy the next candle. Even though it's predominantly in a pretty significant downtrend, but you can see how the market starts to turn around. And again, there's numerous names for this candle, Pinocchio, pin bar. I've heard all kinds of different names for it, but just understanding what that looks like. And when we see this, we want to react to it. So when we come back and we look at the Euro-US, again, the Euro-US candle, the same thing is predominant right here on this candle. You have that long wick. You have the body is about 20% of the entire, 20 to 30% of the entire move, and the bottom part of that body has no wick attached to it. That is a classic reversal candle. You can see again here, it broke through. There was an identifiable area of resistance. It broke it. It ran it all the way up. They made sure they got all the stops on the short side. And then within a matter of a day or two, it's incredibly bullish. So these are the kind of things you want to watch for. Going into 2014, watch these setups very, very carefully because they are going to be leading indicators as to what the real move is going to be to start the year. And that usually takes place around the second week of between the second week of January and the second week of February. We're going to hopefully see some trending markets, but know your setup. So when you're looking at this, be very, very cautious of these types of setups. You see them all over the place. They don't come around that often. You can see there's another one right here. I'm going to show you this one also. And this is, again, a bearish warning of a bearish reversal. So within the trader goes here, the next candle opens up, you sell on that candle. That led to a massive move to the downside. From the 92 level all the way down to the 88 level, I see traders fighting it out every day. Trading on the 15-minute to 5-minute time frames, try your best to stay away from those time frames because you're never going to get a true price. Look at the bigger picture and then go back. So right now, the primary basis of doing this is we're looking for the correlation. The correlation is 100% on the U.S. Swiss franc. The Aussie-U.S., not so much. There is a correlation there. I would say the correlation on the Aussie-U.S. currency pair probably more along the line of about 70%, but the Aussie can be its own animal too. And that's evident here. You can see that the dollar moved up. There's been times here over 2013 where the Aussie and the dollar gained strength together, which I also found very, very interesting. When I look at the CAD, there is a very, very high correlation between the dollar index. Even though the CAD makes up a very small part of the U.S. dollar index, it's still very, very valid. So we can see the correlation here when we get a signal. So even if you're using standard moving averages, whatever indicators you're using, if you see a big move in the dollar index, then you definitely want to jump on board for that type of move. It's very, very important. So we can basically go through here and assess what's correlated, what's not correlated. The New Zealand US, this correlation I would put at about 60%. It's very small. But the dollar yen, again, the dollar yen can be a very tricky pair, but we're looking at the key levels. The key levels here, you can see right there, their correlation is still there, but the yen and the dollar, in a lot of times, can go together. And the reason that can be a risk on, risk off trade. I'm sure everybody's heard that. And we want to be careful of that if it's a risk off environment. If it's a risk off environment, the yen can actually overpower the dollar. So you have to be a little bit careful on that, but just for the most part, know your correlations. You can see that this big run up on the Japanese yen, the dollar index was actually struggling a little bit. So the correlation dollar yen, I'm going to put this one about 65, 70%. So that's the predominant what we want to look at, understand what's correlated. But the main thing is here, guys, I've talked about it in my past webinars. Go over to Windsor Direct. You don't have to trade live there. I don't trade live there. I've had a demo for years and years because you can get free contracts on the dollar index, the S&P 500, on gold, light sweet crude oil, a number of other futures contracts. This is great stuff, guys. In the U.S., a lot of the guys are paying $200 to $300 a month for these kind of charts. You can get them for free on Windsor and then bring up your indicators. Not a problem whatsoever. So when we look at all these indicators, the main thing we want to do here is we want to be able to identify the overall range. Now, you can see that I've got some moving average crosses in here. I've got a number of other different indicators, but some of your main ones. A Donchian band is a great indicator because it commits. When we look at Bollinger Bands and some of these things, they're very non-committal. And what I mean by non-committal is they tend to be wide open as the market's going up. They open up very quickly. I would also recommend moving your Donchian band from a 20 period to a 30 to try and weed out some of that market noise. Now, when we look at this, when we look at the euro a little closer here, now again, you can see that I've labeled this for our chart so we can look at this closer, that essentially this pin bar, there's that candle, and again, it's coming off that trend line. The next candle was quite bullish. Everything looked great, but then it immediately collapsed. So from here, again, the trader could come into the daily time frame, look at this at the end of the day, and when this candle closes right here and this candle opens, so if this candle opens right here at 137.55, immediately a short trade is entered, immediately. And you can put the stop can be fairly tight on this, about 80, 90 pips. If 80, 90 pips, is too much for you, then simply lower your position size. And that is, again, something that's very, very important, that we lower that position size. So when we look at the euro, we look at it a little closer here, it's turned bearish. Now, when we look at it in the monthly time frame, again, we've got a very mixed signal. We've got these Pinocchio candles or these pin bars side by side. One saying bullish, the other one saying bearish. So at this time of year, and I can't stress that enough, we go back and look at that dollar index. So to reinforce what I was saying, we come back here to the dollar index. Until this breaks, Euro-US is not going to break. So the dollar index will be the leading indicator for what happens to Euro-US. And this type of analysis, and moving away from single market analysis, covering your charts with all kinds of different moving averages, all kinds of Fibonacci. A lot of people say that there's only one Fibonacci level that matters anyway. So, and that's the one you should focus on, which I think is 61.8. So, all those other ones, they really don't have any meaning to anything. But, that's just in my respectful opinion. I want to keep this as uncluttered. And I know that if something happens right here, that I can immediately respond to that in the currency markets by buying US. If this upper trend line breaks, I can sell Euro-US immediately. I can buy US Swiss franc. I can sell pound dollar. There's an immediate reaction to what can happen here. So right now, when we're looking at these things, there's a lot going on that, that would lead us to believe that the dollar is strengthening. But don't forget that range is not broken. So when we look at this in the weekly time frame on the Euro-US pair, there is that candle that I've talked about, and it is a bearish one. So right now we can assess that the DXY, the US dollar index, which we know the Euro-US correlation is 100%. Okay, 100%, not 98, 97, it's 100%. So this is showing us we've got a classic pin bar candle sitting there. We've got the dollar index challenging that trend line resistance. This is pointing towards a bigger move coming to the downside, but we've got to get through 135.30. If we get through 135.30, then this thing's going to run.